Welcome to SmithWeekly Discussions, an occasional program for our members of SmithWeekly Research. Please note this program is a private discussion and everything contained herein is for entertainment and educational purposes only. With that, we hope you're in a comfortable position along with your favorite beverage to enjoy the discussion. We remind our audience to examine our show notes attached to each of our shows to better understand how our program functions. Before we get into our discussion today, we want to say thanks for questions coming from our audience of SmithWeekly, including Doug A., Jake V., Paul M., and John D. On the program today is a new guest and one we're pleased to introduce. Mr. Don Simmons is on the program. Don is the president and CEO of Hemisphere Energy, an Alberta, Canada-focused heavy oil producer that is currently producing oil from the Atlee Buffalo project in southeastern Alberta. The company uses polymer flood oil recovery technology that improves recovery and also reduces decline rates. Presently, the company is producing at its highest level at over 3,800 BOE a day. Hemisphere Energy is listed on the Toronto Venture Exchange under the symbol HME, as well as on the US OTC markets under the symbol HMENF. Mr. Simmons, it's great to have you on the podcast for the first time. Welcome, sir.
Thank you. Thank you for having me. Pleasure to be here.
Yeah, Don, it's great to have you on, and been looking forward to having you guys come on the program. And it's always good to mix up our natural resource focused program and get in some oil companies here that are producing in different areas or exploring in different areas of the world. And certainly Hemisphere is one that's been on our radar. So it's great to have you on. And of course, to start things out, you are new to the podcast, and as customary, why don't we have you start off by covering your background and experience in the Canadian oil sector, as well as how you came to the post at Hemisphere Energy?
Sure. Yeah, no, it's a good way to start. Background for me, I'm a geologist by training. So I started in the business 25 years ago, like a fairly normal path for a lot of people in business. Started at one of the larger companies in Canada, cut my teeth there and got a lot of great training and was there for a number of years. And then left there, went to a little smaller private company for a few years to see what it was like at a smaller entity. And then, about, I guess it was in 2008, 2009, life took a bit of a turn with getting married. And I ended up moving out to Vancouver. And that's when I met and got involved with Hemisphere. And it was really just a shell at the time with a bit of money and a small amount of production. And ended up getting involved, and we restructured the company, recapped, changed the board, and started on our path that I always joke it's kind of the longest 5-year plan I've ever had. And we've basically grown to where we are today through the drill bit, through our projects. We've really raised minimal capital. I think we've only raised about $24-25 million to get to where we are today. And it's been quite a journey, but lots of ups and downs as the oil and gas business has. But it's been a lot of fun.
Don, thank you for that. And certainly I can understand the 5-year plan going much longer than anticipated. I can think of a lot of different segments in the natural resource sector where that 5-year plan turned into a 10+ year plan. Congratulations on your ability to be able to raise such a small amount of capital and get where you guys are today. That's not very frequent in the natural resource and energy sector. So can certainly appreciate that, as well as the shareholders of the company can appreciate that as well. And I think it's a good indicator for the audience to hear. How about this one, Don? Of course, I've got to ask you, oil market, interesting times, certainly for 2025. It's always good to get your thoughts, guest thoughts on oil market conditions out there. Any thoughts there as far as how you're seeing the market today, Don? And are there a few things that you might look out or keep an eye on in the oil market to help you assist in making decisions at the company level? Of course, price would be included there, but is there anything else that you see that's really critical that you take a look at on occasion to help you in your decision making?
We talk about this a lot, and we focus on the two main things for us because we're 99% oil, and we're in Canada. So WTI is very important for us, and the price of WTI. And then the Canadian Western Select is our benchmark. And so Those are the two price points, and the effects that affect those two we watch really closely. So WTI, I mean, we're talking about world events, right? Obviously, we have U.S. administration that wants lower oil prices, but they want energy independence and abundance, which the two conflict. So you got to take that into consideration, and then you've got all the world things going on. You've got Venezuela issues, Iran issues, Russia, Ukraine issues, Middle East issues, all that play a role in this. You've got, the tariff discussion, how that could affect not only Canadian oil, but how does that affect the world economy and demand for oil? You've got OPEC things that we look at on a daily and weekly basis and try and determine, what's their mindset, or what's the Saudis' mindset on a given on a given day or a given week. So as you can imagine, there's a lot of variables. Plus, then just the fundamentals of the barrel, right? Like oil is one of the most used products in the world. We use over 100 million barrels of oil a day globally, and we don't have that much spare capacity. When they talk about it, sort of 2 to 4 million barrels potentially out there for spare capacity. That's only 2 to 4% or less. So it's a really interesting time, a really interesting market. But those are things that we watch. I'd say I try and read daily to understand that, and we have advisors we meet with weekly. And then when you narrow in more to the Canadian side of things, the WCS, or the Western Canadian Select, now you're talking about you got to be watching the differential between Western Canadian Select and WTI. And so, what affects that? Pipeline capacity, storage levels in Canada. So those are things we watch closely. You have a pipeline go down, we could have issues. We have a new pipeline now, the Trans Mountain pipeline out to the West Coast. That's helped our differential and narrowed it significantly. So we're making more money because of that. Then you have the dollar, Canadian dollar. Our product is priced in US, but we get paid in Canadian dollars. So it's great. We get this big bump because we have such a weak Canadian dollar. But again, that fluctuates, right? And that moves around. So yeah, it's not a simple thing, and it's something you don't learn overnight. I mean, this is I'd say 25 years in experience for myself, and I've got a team around me with lots of experience. And over the years, we've grown, we've learned, we've made mistakes, we've learned from mistakes, we've missed opportunities, we've hit some things bang on, and you take all that and you move forward. And I guess the last thing I'll say on it is the best thing about all these things, or the best defense, is to have a company that can handle these things and a balance sheet that can handle these things. Then also take control of what you can take control of. We can control our capital spending. We can control our hedging program. We can control some of our OPEX expenses, those kind of things. So that's our approach.
Don, thank you for that. That's lots of good stuff there, and I think we can spend quite a bit more time. I do want to ask you one question about supply chain in just a moment, but certainly the FX clip, the product is obviously priced in US dollars. There's an interesting dynamic there where your OPEX is in Canadian dollars, and the supply chain issues too is a big deal. And then of course, what you guys have been able to put together for a production profile and robustness of that production profile can really play a role here, which we'll talk about a little bit later as we get into some of the specifics. Talk just a little bit about supply chain here, because you covered off that this whole industry is quite fragile, dependent on pipeline, storage capacity, refining. There's so many things that play into it, and if there's one hiccup, it can change a lot. Just talk a little bit about supply chain in the sense of getting that heavy oil out of the ground and getting it off to where it needs to go, and some of the bottlenecks that you guys look at and deal with. Just cover that for us. If we were to say from Alberta, a barrel of oil was to leave, where that typically would go and be sold. Just cover that for some of our audience who maybe isn't familiar with Canadian oil and some of those challenges.
Okay, we could talk for a long time on a lot of these issues, and I think let's just focus, as you're saying, kind of on a barrel of oil, and where does that go. So for us, I mean, we get our oil to surface, we get it to our facilities, we get it to sales quality. And then from there, we truck our oil it's about a 45-minute drive to a terminal, and that's where we get paid. We do the deals with refineries down in Montana and on the U.S. side, but we just need to get that oil to this terminal, and our job's done as long as it is sales quality. Now, when you get to the details, though, just like Hemisphere, we Canada alone, we send I think the latest numbers are about 4.2 million barrels of oil to the U.S. on a daily basis. So we are tied at the hip. Yes, we have some egress now to the West Coast that can go to the Asian market or the Indian market, but we're very much tied to one another. And the U.S. refineries, many of them are built and designed for Canadian heavy crude, and our pipeline egress is directly tied to those refineries. So, we're going to have this relationship we've had it for a long time, and we're going to continue to have it for a long time in the future. And so where do those, on a day-to-day basis right now, things are quite good. We have enough egress in Canada for everybody to produce their barrel and get it to a market. And so things are good. Now, if you have a pipeline down, like, I don't know, last week or the week before, there was the Keystone pipeline had a break. It was down for a few days. I mean, that, we can handle that in our storage, kind of builds up over a few days. It's back online now. But for longer term issues, you can have some problems there. We don't see that too often. When we do see that, that becomes a bit longer term, you might just start to see storage fills up, and then that's when the differential widens a little bit. So it's almost like you're then trying to lower the price of a Canadian barrel to get some people to shut it in. We don't typically, being our size and our high, our low operating costs, we would be one of the last barrels that would be shut in at Hemisphere. So that, from that standpoint, we're in a good position. Canada's in a good position. As we see growth in Canada over the next sort of 5 to 10 years, we are going to need more egress. So that's something that we're going to be interested to see how our new election, our new prime minister, or the continuation of our existing prime minister, how they handle that in getting more pipeline egress in the next decade.
Thank you for covering off some of those things. I think that's important to understand a bit of that supply chain and some of the constraints, bottlenecks, and things that can happen. The other piece too, Don, I think it's important here is as people hear about oil and how important oil is today, substantially important when I look around in my daily life, how much I use of some oil product, whether it be diesel, whether it be oil in the kitchen, whether it be a resin or a derivative of oil extraction that's used in all the products. I mean, there's so many things. And when I sit here and look at it, I think of, well, it's better to count the other direction. What things can I find that do not use oil products? And there's so little options to come up with.
Yeah.
And then, of course, you expand that further into the mining sector in general. And you say, well, what do we use that actually comes from the ground? And then where's a place we can find that we don't extract something from the ground in our daily lives? And when you look at even agriculture, you look at all the fertilizers and the different products that go into agricultural use. You're right back to square one. You're using extractive things from the ground. And so it's alive and well, and there's not a replacement. And so it's very good to point that out for some of the audience that might be listening in to the first time on an oil related company, and also how you guys contribute to that energy use and, of course, product use. One of the other things that's important here too is I'd like to have you give us, before we get into Hemisphere specifically, I'd like to have you give us an overview of polymer flood oil recovery technology. I'm assuming a number of our audience doesn't know about it and how it works, but it's similar to an in situ recovery method, perhaps used in the uranium market or in the copper market. But talk about that, because it's the principal recovery method for the company. Just cover that for us.
Sure. A lot of people haven't heard of it, although it would be in everyone's lives as well, the same polymer that we're talking about. The polymer that we use is used in water treatment plants all over the world. So, again, it's just part of your day-to-day life that most of us don't think about. and we're just using it in a slightly different way. And we're not doing anything new. This isn't Hemisphere technology. It's not a Hemisphere proprietary data or anything like that. We're using a method of enhanced oil recovery that has been around since the 1950s and used in oil and gas, or well, used in oil recovery all over the world. I don't know how many pools, but pools in many, many different countries around the world. And the key is you have to have the right rock, you have to have the right play type, and you have to have the right oil quality. And so we just happen in our two main pools that we produce out of, we have all three of those things that are the right characteristics and variables for a polymer flood. So what is a polymer flood? So let's step back. Most of these reservoirs that don't have oil over water, they're just oil. What we typically have to do is inject water back into those reservoirs to keep the pressure back up in order to recover more of the oil that's there. If you lose that pressure, you lose the inflow into the well, and you might only recover, 7 or 8% of the oil that's in place. So you're leaving a lot of that oil behind. So by keeping that pressure up by injecting water, now you're able to get, let's just use round numbers, somewhere, depending on the quality of the oil, somewhere between 20 and maybe 50% recovery factor. So now we have to take it to the next step. Sometimes we have heavier oil, so the quality of the oil isn't as light. When we think of, WTI, we're thinking of this light crude that flows really well, and you do a little bit to it, and you turn it into gasoline, and you put it in your car. When we're dealing with heavy oil, it's much different. It flows. In our case, we have pump jacks, and the oil flows to surface. It flows through pipelines, but it's much more viscous. So now all we're looking to do is inject something that is a little bit more viscous so that it doesn't streak through the reservoir and go from our injectors into our producers. So that's what the polymer does. It just makes the water a little bit more viscous, more like an olive oil. So when we inject it, it pushes through the reservoir, pushing that oil over from our injectors to our producers, and at the same time it keeps that pressure built up in the reservoir, so now we can recover more. So the advantage of a successful polymer flood is that we will get more oil out of the ground faster, and the key to a lot of this is we get a lower decline rate. So we're used to in the business, and we'll talk about this later probably, is typically you drill wells, they come on at a high rate, and in the future they're producing much less. When you can do an enhanced oil recovery project, you can keep those wells producing at relatively flat levels for a number of years. In some cases, in our case, we're looking at 10, 12 years. We've had some of our wells on production and roughly the same production volumes, right? So to have that less decline rate because of a polymer flood is key to free cash flow. And, that's part of the success of our company. The other part of it is we already know that all this oil is in the ground. So if you can find another method for a little bit more money in your infrastructure, a little bit more money on your operating costs, but you can recover another 5 or 10 or 15% more of the oil that you already know is in the ground. The wells are already there. The facilities are already there. It's the best exploration you could ever do. It's not really exploration, but you're spending a little bit more money to get a whole bunch more value and cash flow out of the ground. So it's a phenomenal way for companies to develop assets, but it has to be the right kind of asset.
Appreciate you going through that. I think it's important because you can levelize some of the production profiles here. You guys obviously have the right play that works here. It's more predictable, as far as the decline rates, and you're really getting more efficiencies out of it, like you said. And so if you can get more out of the ground as well as part of that, plus levelize, plus more predictability, I think that's really a good way to go about it. So I appreciate you going through that, and quite intriguing and definitely an efficient method and well used and well proven over the years. Well, why don't we jump into Hemisphere here? How about just a quick overview of the company, Don? and then of course operations, and then we'll dive into a few specifics.
So as we, I mentioned in sort of my background, we've basically grown Hemisphere from zero to, our most current production number out in the market is 3,800 barrels a day. And so all that has been through the drill bit and through our polymer floods, our water floods and polymer floods, and our projects there. So that consistent growth over the last, call it 10 years has been, in the order of that 10 to 20% of growth a year is what we target. And we're always looking. We're hunters, right? We're technical people looking for the next opportunity, whether it's, kind of organic again, you build a land position and develop it with some drilling, or whether it's making an acquisition that we feel we can squeeze a lot more value out of, more production, more cash flow. And that then leads to really what drives us, what what are we here for? And gone are the days, the business has changed significantly in the sector where companies were just growing for the sake of growing and to get a bigger production number. And I can tell you the market today doesn't care between a 3,000 barrel a day company and pretty much up to about a 50,000 barrel a day company. So if you're like Hemisphere and you are a, almost 4,000 barrel a day company, you have to have a different model. And so that model that works today is really focusing on return of capital to shareholders and really truly building per share growth, not production growth. And so there's a number of ways we do that. When we look at the return of capital, we pay a base dividend. We keep it fairly low because, again, we can't control the price of oil. So we don't want to be in a position where we have to cut that back. So that we keep that fairly low. I think today that's in around a 5 to 6% yield. And then from there, other methods we use to return to shareholders are through special dividends. So if we have an extra, really special or good, or a quarter or half a year or a year, we've done, I think, 4 special dividends to date over the last number of years. And then the last thing we'll look at is the share buyback. So again, we see opportunities, especially on days, and unfortunately we get more days where oil will drop $4 or $5 than I like. But on those days, somebody might panic and sell their stock, and they'll sell it cheap, and we're able to be in the market picking that up, and at the end of the month we rip it up. So again, this is all mechanisms focused on adding value per share, not necessarily just trying to build a 20 or 40,000 BOE a day company. It's really driving that per share growth.
You're going to attract some different investors here, and that's what's key about some of the demographics you're targeting and some of the strategies is you have the opportunistic buyback. People see that value. You have the expansion and continued business operations to size up, level up if you want on that front, which obviously capital allocation. Then you have the base dividend. You're attracting dividend investors as well. They see the growth. They see those other things that can come in and enhance what their investment is. And so I do think that's important to point out because you have a different demographic that would be looking at this company as well, rather than just the general, exploration, gold company, speculator type person, but also they themselves understand the diversification to be able to come into other areas, come in here, look at cash flowing companies, have an investment, have an exposure there because it's a safer place to put capital with good operators like yourself. So I think that's important to cover off. With that, why don't we dive into capital structure, Don? Cover where we stand today on cash on hand, shares outstanding, and then, of course, an important thing to point out here would be the management and board ownership in the company.
Yes. So, just for simplicity, we're about 100 million shares outstanding. It's basics, lower than that, but for simple math, that's typically what I say. Insiders own 17 to 20% of the company. So where that really, drives things is we are aligned with the rest of the shareholders out there. Decisions that are made are based on how is this going to affect share price in the short term, medium term, and long term. And then that then leads to, sure, a market cap of, I think we're trading around $1.75 or something today. So we're around $170 million market cap. But at the end of the year, we were sitting on about $6.5 million of cash. So our enterprise value is actually closer to around 160 million dollars. So it's an interesting number to keep in mind. And I'll remind, as we go through this, when we look at some cash flow multiples, where we trade and where the market in general is right now, with these lower cash flow multiples that we've seen in the industry in the Canadian side for a few years now. And then also the other way to value companies, and I think we talk about it later, but is looking at reserve reports. And all that is just a reminder to everybody, that's just an estimate of your future cash flow. So again, I'll remind people of that sort of enterprise value when we get into those discussions.
We will come back to that valuation here towards the end and have you talk a little bit about that. With you guys already, we're nearly 5 months in here on 2025, so some of those questions have been answered as we've proceeded here. And then, of course, a lot of uncertainty is still left in this year. But considering cash flows expected from operations and, of course, the current balance sheet, talk about roughly where you would stand on capital allocation towards CapEx work items, that expansion, and of course maintaining existing production, the dividend policies, which there's basically two there, special and base, and then of course the potential for buyback of shares with excess capital that's left over. Talk just a little bit about those items.
Yes, absolutely, and it's something we talk about all the time, both as management and as board, and shareholders. Often we talk about this at length, and I'd say everybody has their own different opinions on things, but I'll give my my philosophy and how I look at this, and how we sort of have structured our year in some cases to have the flexibility around this. So we put out the guidance. We like to tell shareholders early in the year, given where the price of oil is at that point in time, what our plans are for the year. And so just to recap for Hemisphere, when we put it out in January this year, oil was about $75 WTI. Our goal or our target for the year is to be averaging 3,900 barrels a day, average for the year. So what that does at $75 WTI, that's about $50 million worth of cash flow. And now we're in a different world today. It's not 75, it's just below 65. So we also add these sensitivities when we put out guidance. What if oil's, in our case this year, what if it averages 65 for the year? And then on the upside, what if it averages 85? So I'll talk a little bit about some ranges between that 65 and 75, because that's where we are today. So we're looking to make this year $40 to $50 million of cash flow. And that then on top of that, we've got the $6.5 million worth of cash that we entered the year with. So we're in a great position from a balance sheet wise. From a capital expenditure wise, at that point in time back in January, we've got planned to spend $17 million this year, drilling some wells, some facility upgrades, buying some land. We've got one pipeline to build and put online. But I'll stress that we don't spend much money in the first half of the year. The best time to drill wells and do this work in the field is Q3 and the early part of Q4. So over the last number of years, unless we have to or we really want to accelerate something, we plan for the majority of our capital spending through the June, July, August, September, and maybe a bit into October. So that gives us tremendous flexibility in a year like this, where oil prices drop $10. We can easily rein in, if we choose to, some of that $17 million. I wouldn't rein it all in, but there's certainly flexibility on that. So that now leaves us, even in this price range, somewhere in the order of 24 to almost $40 million to have in our free funds flow, plus the cash, right? So tremendous flexibility. The base dividend is there in order to, and I joked, like, basically pay people to be shareholders. The base dividend's it's 10 cents a year, about $10 million. And so we still have that extra cash flow there, even in a lower price environment, for the other things. And then we'll just look at, I would say just apply some common sense to what's happening in the market at any given time. Do we have an acquisition that we're excited about that we're going to want some money for? Let's build a bit more of a war chest. Do we see more and more things entering the market for divestiture? Let's keep that war chest. If we don't, and we had a great quarter, we're building cash, let's look at a couple of ways to return some more to shareholders. We just announced, and I think next week we pay another special dividend, 3 cents a share. I think that's our fourth special dividend over the last, I guess, 3 years now, of 3 cents a share. Are we trading? We're trading below our reserve value, our PDP value. Should we be buying some more stock in the market? Can we buy some more stock? Do we, how do we do all that? And, you need sellers in order to capture that. So all of those go into the decision making. But I would say we're in a very enviable place when we have this ability to make those decisions and see what's the best thing at that time.
I think it provides a lot of flexibility. You guys can change some of the ideas from a management side based on what the market is doing, based on share price, based on operations. So I would say a very good position to be in too. And then of course it does reinforce also the investment thought here, where you have an equity that's undervalued from the basis of where you guys stand on reserves. You can look at that, and you can also look at, you get paid while you wait, going back to what you said about, paying shareholders to hold the stock, right?
Yeah.
And so I think that makes a lot of sense there. Don, I want to come back to that here in a moment as we talk, remaining on the management side, just talk a little bit about some of the staff and operational folks that are helping to support your lead at Hemisphere.
Sure. So we've got, the 5 management people, we've been together now through a lot of ups and downs. We've been through the downturn. We've been through COVID, and I think what really, not only are they great people, but also we all knew we had a very special asset. We just needed some capital, and we needed some time to get it developed. And so, COO Ian Duncan, top notch. We've worked together for a long time. CFO is Dorlin Avancic again. This is a guy that when we first met had never actually worked on the oil side, but has just a phenomenal CFO. I really don't have to worry about that side of the business. It's great. Ashley Ramson Wood, our CDO, our Chief Development Officer. We work together a lot. Like she's a reservoir engineer, but she helps in the capital planning, the evaluations of all the different assets and corporate things that we model and we look at to potentially acquiring. She does all of our reserves, and she can even step in. There's times when I haven't been able to go to a conference and give a talk, or we've had 2 at the same time, and she easily steps in and can tell this story probably better than I can in some cases. So it's great. And then Andrew Arthur, we've worked together now a long time. He's the other geologist. I joke it's a good day when I get to do a bit of geology, and for him, at least, he can do geology every day. It's great. He keeps the programs going from the development side. He helps us, look at and map new opportunities out there. And he's someone that, I grew up, as a development geologist, very hands-on on the drill programs, and in some cases, being on the rig while we're drilling for at least certain parts of wells, it was really important, especially, when Hemisphere was just getting started. One little communication breakdown and you can be in serious trouble, lose $1 million well in a hurry. And so Andrew stepped in years ago and really took the reins of the drilling operations from my plate, and he just does a phenomenal job. And again, there's hardly a well that he is not on the rig to make sure it is drilled to the best that we can drill it with our other geologists on site and with our directional drillers and with the rig crew. And yeah, just phenomenal team, and we're backed by a very supportive board of directors. So yeah, it's special team.
That's also good to have a group of people that are all acting together in concert in this operational effort, and also looking out for shareholders and really seeing the vision overall strategy as well for the company. I think is important to work together rather than having, you know, often we see you and I can probably have a laugh about this. In the junior sector, it's wrought with conflicts of interest and all these things out there, people fighting and bickering over this and that and the other, in these little junior co's. So to have a team that's tight, working together to see that vision through, I think is important. Then also, of course, have some of those leaders lead the way, like yourself. I think is very important. So I appreciate you going through that and how you guys approach that effort. Okay, I want to shift over to the Atlee Buffalo field. You guys have 56 wells in production there. Cover the planned expansion work, of course, further land acquisitions that have just recently been done. And then, as far as if you can, talk a little bit about schedule on some of these milestones that would be coming online for the company. And then from there, we'll shift over to the other field.
Atlee is the heart of the company. It's the engine. It's the cash flow machine. It has been and it will be for years to come. So these are two phenomenal pools that, as I mentioned when we talked about the polymer, I mean they're perfect for polymer flooding and for enhanced oil recovery. And so, if you see a map of it when you're flipping through our presentation at some point, you'll see like there's a lot of wells there now. There's a few more wells to drill within these existing pools. But from now on, I mean, I think we have a comment in there where we've got about 11 million barrels of proved reserves now to recover from these two pools for spending like 20 to $25 million. So this is what we call now cash flow harvest mode. So yes, there's some tweaking we'll do here, and there's some things to add, and there's some new zones that we're going to test and try, and there's some step outs that we'll do and continue to try and expand the production footprint here. But the the real key and the real what we're looking from Atlee is just to continue to perform and have that low decline and continue to spit out that not just cash flow but that free cash flow that then allows us to go and do the other parts of the business. So yes, pay the dividend to our shareholders, but also allow us to go out as a team and do what we do technically to go look for other opportunities. And not just in our own backyard, but I can't stress enough, like we're a team that we're definitely hunting, and we are aggressively looking for opportunities, but we're very picky on what we want, and we definitely want to see assets or test assets that have significant upside potential. So I think that is really sums up Atlee and kind of pushes us into probably where we talk about next is some of the future of the company.
Donna, give us a little bit more there just at Atlee as far as, how you see existing production profile there continuing on and any immediate concerns with existing production. I assume it would be supplemented. You guys continue to expand here. And then also the land acquisition, I'm assuming, is part of that expansion effort. Just talk a little bit more about that.
Yeah, so we're continuing to still expand our polymer flood in these pools, right? So we still have wells that we're converting from producers into injectors, and typically what happens is you'll see these wells they might come on anywhere from 50 to 150 barrels a day. They may decline a little bit, and then you put a new injector in nearby, and all of a sudden those wells will go back from 50 back to 100 or 150 again, right? So we're still continuing to expand the flood. There's still some more wells to drill here, another couple years worth of drilling in here, but the bulk of the capital is spent on these two pools. So we will be producing, these pools will be producing 20, 25 years from now, right? So the key though, over the next number of years is keeping that production profile, increase it a little bit, but hopefully keep it flat with this with the polymer flood. That's the key to these pools. From expansion point, yeah, we've got some lands we've picked up in the area. We continue to monitor and look for other opportunities here. And yeah, in 2025 we do plan to test a new zone and just see how it goes. But again, we don't tend to talk too much about that. Mostly just because let's test it, let's see how it goes, and then there could be other lands we want to acquire in the area, and we just our competitors could listen to this just as much as investors. So we tend to not talk a whole lot about our exploration, our new ideas until we've got them all tied up and ready to go.
Absolutely. Makes sense. And I appreciate you giving us a little bit more info there. And of course, definitely don't want to say anything in this business without making sure things are locked down from numerous angles. So appreciate your thoughts that you did give us there. I want to shift over and we'll come back to production profile valuation and stuff in a moment, and also cost profile. But just over the border from Alberta in
Yep.
Saskatchewan, the Marsden field, you guys now are doing some test pilot work on polymer flood there. Talk about the status, what's happening there on the ground, and then what are the next plans on this project?
Yeah, so I think this it's important for existing shareholders and potential shareholders to understand our mindset on how we approach these type of things and new opportunities. So this is one way to expand the company's production and cash flow into the future. And I'll talk about that. Another way would be to buy an asset that's producing, or a company that's producing, and further its development. When we look at Marsden, though, there is no production involved in what we acquired here. We acquired just land. And however, though, there's historical wells on this land and oil pools, and fairly significant. But those oil pools were all developed with older technology, so just vertical wells back in the 80s and the 90s. And they took out about 7 or 8% of the oil that's in these pools. And that was very similar to what had happened in Atlee. And so we acquired the land we could. I think we have about 13 sections now, maybe 14 sections of land. And so if we can unlock more of this oil, we have already a good footprint to be able to expand our operations. So what you don't know is, will going with horizontals versus verticals, and will going with a polymer flood, how much more oil can we get out? And is it economic? So that's when we do these pilot projects, right? So in this case, we went in last year, we drilled 5 wells, and we turned 2 of those wells right away into injection wells. So we're injecting this water and the polymer into those wells. And so now we have to wait. We're in the waiting period. In Atlee, it took about 12 months in order to inject and build the pressure back up in this reservoir, because they depleted that pressure back when they took out the oil in the 80s and the 90s with the vertical wells. So we want to build that pressure back up. And the hope is we're also going to push some of this additional oil over to our producing wells. And if it works, then we'll be able to establish what kind of rates on average should we get from wells here, and then run economics, right? What's the cost of the operations? How much oil rate per day are we getting? And how much then ultimately do we think we can get per well? And then we can say, this is a economic project, let's scale it up. Or we'll look at it and say, these economics don't cut it. We have better projects, or this just doesn't make the cut. Let's clean up and move on. That's why we do these type of polymer pilot projects. And the other thing I'll add to it is, we're not looking for projects that add 100 barrels a day here or 200 barrels. Like, we are really looking for projects that we can add, I'd say 1,000, 2,000, 3,000 barrels a day. Something that's meaningful in a fairly tight geographical area. We don't want to be spread out all over the place.
we'll be watching to see what happens on this one as far as the field goes and the potential for good success here. So appreciate you covering that one off. It's definitely one that that investors should be paying attention to. I think if you guys are putting forth the efforts here and taking the risk, I do think that would be probably a pretty good certainty of a reasonable outcome here. But we'll wait and see, and definitely can see that expansion strategy playing in here, the different ways you guys are doing that. So I appreciate the thoughts on that. Back to just the overall sensitivity, and maybe we can speak sensitivity and we can also speak costs here as to where, so investors have a feel for both the upside leverage and then also the downside leverage as well, as to where I wouldn't say shut in, but definitely, board up the windows, so to speak, if the oil market does decline, which typically is temporary in nature, just based on when you look at the world today and you look at new discoveries, you look at production capacity, you look at permitting challenges, depletion, all those things that play into the oil market today, besides the bifurcated markets and the different folks you'll do business with and the folks you won't do business with. I would say overall, long-term oil price outlook is quite positive in my opinion. But without going into some of those details, maybe just talk a little bit about where you guys would stand on the sensitivity of the production profile, both on the downside and upside, and then the leverage that comes there. I think that's important for the audience so they can get a flavor of that type of leverage that the company provides.
Yeah, and I think that's totally agree with you, which is why when we release guidance, we like to put those sensitivities. Now, again, back in in January, oil was 75, and we thought a fairly conservative downside case was 65. But you can see, it's about $10 million of cash flow as you go down that $10 WTI. Right now, that it's not linear exactly as you go down from that because in Canada your royalty rate actually goes down with the lower price of oil. It's almost like a natural hedge on crown land anyway in Canada, so that's a benefit to the producer. But you can see like we have quite a lot of flexibility as the price of oil comes down, and what we talked about is we have a lot of flexibility in our capex program. So we could reduce that capital expenditures program from 17 probably to 7 or lower if we really, really thought it was important. Now, what does that affect? That affects 2026 growth profile, right? So instead of then, growing that 10 to 20% next year off of existing stuff, that it might be more of a stay flat type maintenance capital type program is what we'd be looking at in that case to still be in that 39 to 4,000 range. So that's what you're giving up if you really start to see the lower price, sustained for what it is 6 months or more. I think we talked about that a little bit before. Do I see a good reason for oil to be $50? No. Do I see a good reason for it to be 80? No, I don't either. But I do believe, in this, call it 65 to 70 range, 75 makes sense. Now, the oil market doesn't always make sense, but from a fundamental point of view, that's sort of a range that does still make sense to me right now.
I think when you look at this, I think you just look at the market here. There's obviously a lot of incentivization from a lot of producers to not have the price fall into the 30s and 40s. And at the same time, there's also a sweet spot there too. I do still think, given some of the sentiment out there, some of the policies that are out there, and then also just the bottleneck in permitting of projects, and basically, I hate to say it this way, Don, but the anti-oil movement, if you will, which you and I both know doesn't make any sense. But the whole point is those things come into, some of those policies affect government decisions, permitting decisions, given that the world is consuming very high levels of energy to all different sources, including oil. You can certainly make a case that oil prices are going to remain pretty healthy going forward. But there is those fear events, and you know this firsthand. You saw March 2020. You saw the price of oil come down and go negative for a short period of time, and then rebound quite rapidly. But there was a short period of time there where people were where a lot of fear was out there, investor fear was out there, and those things happen for a short period of time. And obviously, you have to be able to navigate those and remain solvent through those periods. So I think it's good to highlight some of that torque that you guys would carry, a sword that cuts both ways, as you well know. And so appreciate that. And then just with respect to overall valuation here, Don, based on the recoverable reserves that the company holds, as well as, of course, the balanced growth and return of capital to shareholders strategy. Speak a little bit about that valuation. You guys published some information on this out there. Just talk a little bit about that net asset value and where you would expect a reasonable market, I suppose, valuation for Hemisphere Energy.
Yeah, this has been a topic, and we've been chatting about it in the Canadian oil space here for a while. And the market, to me, is really fixated and has been stuck on a cash flow multiple for valuation. So it doesn't really, almost hasn't really mattered your size. It hasn't mattered unless you're a major. But if you're a small cap to mid cap, doesn't really matter your size. It doesn't matter almost. Well, maybe if your balance sheet's a bit stretched, you're on the lower range. But that range of cash flow multiples been, call it 2 to 4.5 times. Historically, companies in that junior to mid cap would have been, I'd say, at the lowest, a 4 up to maybe a 6, 7 times cash flow, right? And it's really been just in the last couple of years we've been stuck in this lower range cash flow multiple. And I run into people. Well, no, it's structurally changed. Investors have changed. I don't think so. I mean, I still look at it as markets are built on greed and fear, and right now there's just more fear on the oil side to be an investor than there has been greed. And I do think we'll get back there. I just don't know when. So that's one way to look at it. And that being said, where does Hemisphere trade on that? I mean, bringing back our $160 million enterprise value today and our $40 to $50 million worth of cash flow for the year. So we're trading in that 3 to 4 times. And so not at the low end, but not at the high end either. And so, I think there's certainly room for expansion there, Hemisphere included. And because of our low decline, our balance sheet, uh, the type of assets and cash flow we have, high net back barrel, we really should trade at the high end of a cash flow multiple. Now let's flip over to the other way, and certainly something that I like to really look at as an investor. I like to look at reserve reports. I focus on their proved reserves and their proved developed producing reserves. I also focus on this as a CEO when we're looking to buy assets or buy another corporation. Those are the two main categories that I'll really hone in on. When it comes to Hemisphere, our blowdown case, our proved developed producing reserves, we don't drill another well. It's 9 million barrels and $270 million worth of value. So per share, that's almost 280 a share, and we're trading at a buck 70 today. When I look at the proven now that's adding some extra capital. There's other wells to be drilled. There's some more oil to be brought online. For us, that's almost 11.5 million barrels of oil. And the valuation on that is almost $320 million Canadian. So, 320 per share. And funny enough, if you go back to, historical way companies traded, they traded on a, like I said, 4 to 7 times cash flow multiple and proven reserve valuation. So for Hemisphere, sure enough, that'd be like a 5 to 6 times cash flow multiple and would be equivalent to our proved reserves. I don't think that's a far stretch to say that the market will go back to those levels. I wish I knew when. I don't know when.
Let the investors in the audience pick a few of those different metrics and sort out what that would be. And we've talked enough here, and plus with the financials, they can sort out how things look as far as on the downside case and upside case, and to get to the historic metric medians, I suppose, plus maybe some upside in the oil price being $70, $80 a barrel, which is certainly plausible. I think that there's certainly some good upside here. And then, of course, the big positive thing here that I'll have to re-highlight, Don, is that folks get paid to hang out. This is going to work out pretty well. And on the downside, I don't think there's a lot of downside case to a point where this doesn't work out. I do think overall, folks out there still there's a lot of market uncertainty and there's a lot of volatility out there. So I know that there's broad market fear and investors coming out of all the popular trades that have been happening over the last few years. But certainly you have to come back and take a look at the value and take a look also at the safety factor that you guys offer at Hemisphere as well. So very good stuff here. I guess with that, why don't I take any other comments that you wanted to add in, Don, and then let me just leave you with this question. And I think we've covered this in different phases here as we've talked. But first of all, I want to thank you for your time to introduce Hemisphere Energy to our audience for the first time today. For potential investors who are listening in, the company has a market capitalization of about 170 million Canadian dollars today. Why should Hemisphere Energy be considered within the institutional, family office, and retail investors' portfolio at this stage?
Well, and I think we have talked. We kind of summed that up well in our previous discussion there. I mean, and we do pay people to wait. We pay people to wait, and we pay them what we want to be paid as well to wait because we're shareholders as well. And from there, where is the upside? Well, we talked about it. That multiple expansion that we've always seen the market come back to. We've got that. We've got, if you believe in commodities and you believe that we're going to continue to use oil around the world on a daily basis, and we're not going the other way, I don't see us losing less oil in the future than what we use today. So we're in a great commodity to be in. And from there, I mean, we continue to grow on our base assets, but you've got a team you're investing in, and that's why I like to do these discussions and have these discussions, introduce ourselves. I mean, we're the type of team that is hungry to look for other great assets. And we may not, you may not nail one next week or next month, but I'll tell you, we will find one, and we will continue to find ones that add significant value for shareholders. And you're investing in a team that is very focused on that per share value growth. And I think the whole industry is kind of moving towards this model, which is very different, and where investors really got burned in the past is oil companies burnt through cash, not adding value. And that is not what you're getting here at Hemisphere. We're exactly the opposite.
And Don, what is the best way for folks to reach out to the company for further information?
Call me, email me. That's my job. I talk to people, whether it's through text or email or a phone call here to the office. It's all on our website. It's all on the presentation. I think it's on the back page. Our website has the latest presentation on there, so you can flip through that. We've recently put out our year end, so you can have a look at our year end numbers from 2024. Our reserve information has all been released as well, so you can go through that. But yeah, if you have any specific questions, I'm the best guy to chat with. If it's not something I can answer, then I'll make sure our CFO or someone else here that does know the answer, and I'll get a hold of them and we'll get back to you.
Mr. Simmons, great to have you on today, and we look forward to having you back in the future for updates.
Thanks a lot. Real pleasure.